Good morning, traders, and welcome to BCI's morning market analysis. First up, let's talk about the US dollar. The DXY remained volatile last week, plunging to a 4-year low at 95.56 before rebounding towards 97.1. Despite the bounce, the dollar is still heading for a second straight weekly decline as geopolitical tensions and policy uncertainty continue to weigh on confidence in the reserve currency. Pressure came from President Trump's tariff threats, warnings of possible military action against Iran, and anticipation around his Fed chair announcement. A temporary deal to avoid a government shutdown helped stabilize the dollar late in the week, but the broader outlook remains fragile. Technically, the medium term trend is still bearish. The index has rebounded from oversold conditions, but moving averages remain negative, and momentum indicators offer no clear reversal signal. A break below 97 would reopen the downside risk towards 96, 95.56, and the psychological level of 95, while any meaningful recovery would require a move above 98. Next up, let's have a look at WTI crude oil, which recorded its best month since July 2023, rising to 66.24 per barrel last week. Gains were driven mainly by geopolitical risk premiums, particularly escalating tensions between the US and Iran, with concerns focused on potential disruptions through the Strait of Hormuz. Additional support came from earlier tensions in Venezuela, supply disruptions in Kazakhstan, and tighter global supply conditions. Major investment banks have also raised full-year oil price forecasts, reinforcing the bullish narrative. From a technical standpoint, oil remains in a firm medium-term uptrend, supported by a golden cross between the 100 and 200-day moving averages. The late-week pullback towards 65.5 appears corrective, with support around 63 to 62.5 and a stronger backing near 61.94 to $61. A move beyond recent highs could shift focus towards the $68 to $70 zone. Next up, let's have a look at gold. Gold experienced extreme volatility, surging to a record 55.98 before collapsing more than 10%, closing near 48.50 on Friday as heavy profit taking hit precious metals. Even though gold still remains on track for a sixth consecutive monthly gain, supported by persistent geopolitical uncertainty and a weaker US dollar. Key drivers include rising Middle East tensions, new US tariff actions tied to Cuba-related oil trade, and uncertainty around US monetary leadership following Kevin Warsh's nomination as the Fed chair. ETF demand remains strong with holdings near 4-year highs and gold up roughly 24% this month. Technically, the medium-term bullish structure remains intact, but short-term momentum has cooled sharply. Prices are likely to consolidate between 47.69 and 54.51, with support near 47.72 and 47.69, and resistance at $5,000, then 5451, and the psychological level of 5600. Lastly, let's have a look at the local currency, the Australian dollar, which briefly traded above 70 cents, hovering near a 3-year high, extending gains for a second straight week. Strength has been driven by US dollar weakness and rising expectations of an RBA rate hike next week. Markets are pricing in about a 70% chance of a 25 basis point rate hike, with all 4 major banks expecting rates to rise to 3.85%, though most economists view this as a one-off move. The Fed, by contrast, continues to project rate cuts later in the year. Technically, the pair remains in a clear medium-term uptrend, supported by a bullish channel and an inverted head and shoulder pattern. Momentum has eased slightly, pointing to potential short-term consolidation. Resistance sits at 70 to 71 cents, then 71.44, while support lies around the psychological level of 70 cents, followed by 69.15 and 69 cents. Well, that's all for today's morning market analysis. As always, manage your risk and happy trading.